So again, there's a lot of new people in here. I'll be quick and just tell you, again, my name is Sam Seiden. Happy to be here today with you. And from Online Trading Academy, I'll give you my email address and everything as we go along. Okay. One of the things that I typically talk about, I haven't in a while, is just focusing on the very, very raw basics of trading. When you think about why so many people lose in trading. Okay, let me grab the chart first. Okay, sorry about that. I just grabbed the chart for everybody again, so hopefully you can see it okay. All right, this is a chart of the dollar against the Japanese yen. Okay. All right, let's quickly talk about why so many people lose in trading. Right. Number one, trading. The trading education world is for the most part not regulated. Okay, there's not a whole lot of regulation that goes into the trading education world. Okay, which means that if you're a very slick marketer and you're good with some PowerPoint and you've got some creative ideas on rehashing old conventional technical analysis and things like that, you could probably create a nice little trading education company and get people to buy your education, and which an industry like that is going to invite in a lot of trying to be politically correct here, but a lot of kind of slimy, not your most ethical business people. Number two, of all the education out there, there are so many books written about trading, so many seminars and webinars and you name it. How much of it is actually proper education? As you see with the books in the bookstores, most of it is just rehashed, conventional technical analysis. Someone comes in and changes some colors, changes some names, and you've got some education. Okay? Yeah, shady is a good word there, Frank. Let me give you a couple examples. Let's talk about, this one's fresh in my mind because someone actually asked me about it this morning. Someone asked about a doji candle. There are books written about doji candles, and you could find information on doji candles anywhere. People call them, some of the most powerful candlestick patterns ever, these doji candles. But somebody tell me, what happens when you see a doji candle on a specific chart on a specific time frame? What happens when you change that time frame? What happens to that doji candle? Right, it's gone. There's no doji candle there anymore. Does everybody understand that? Okay, I'm not saying throw doji candles out the window, but they are very, very secondary at best when it comes into your hierarchy of importance of what you need to be looking at. Okay, does everybody understand that? And that's one of many, many, many examples, right? I could go on forever about that. The books are not going to tell you that. They're going to have you looking for specific, doji candles at specific points. Okay. All right. So that's why it's so important. Those are two reasons why a lot of people are not successful at trading. Another one. A third reason is because we're human beings and we want to be right. Human beings have a tough time being wrong. Okay, but I can tell you from experience, having been around so many traders for so many years, people have a very tough time accepting that you're going to be wrong sometimes. Okay, the people that do make money, often those people are only right half the time, maybe a little bit better than that. There's people that are better than that, but you don't have to be. And that's another conversation I had with someone very recently. She's kind of new at all this, doing she's doing okay now, but she went back and looked at her numbers. She said, I'm only batting 50-50. And she said, but what was amazing was to see how much money she was making. So be careful with that. Okay. Let me grab the chart one more time for any latecomers, because I don't think they're able to see the chart one last time here. There we go. Okay. All right. Yeah. Forex, you've got to be very, very careful. That's why one of the reasons why I kind of stick with doing things with FX Street. It is literally the Wild West out there and if you don't know what you're doing and you don't know who you're dealing with, you've got to be very, very careful. Okay. All right, but let's get on with the really important stuff. Okay, I just grabbed the chart again, so it should be fine. I just have one chart up there. I see a couple people are having little issues with it. There we go. Okay. All right, let's move on here, and then I'll jump back and look at some of these questions. Okay. This brings me to what I consider the most important thing in trading. And again, it's just my opinion, but it comes down to the foundation of your trading belief system. Okay. I mean, are you looking for, what's your strategy? What exactly invites you into the market? Are you a breakout trader? Are you looking for reversals? Anything like that. What is there a specific candle pattern that gets you interested in the market? All right. For me, because of how I started my career, which is on the floor of the Chicago Mercantile Exchange, actually in the currencies. Okay. It is for me. It was very clear. Okay. I was handling institutional order flow. Right. If let's say the yen here is trading at 107, right? Well, let's take a real example. Look up there, those two lines they have on the chart. Say the yen, trading 107, right up there, the bottom line there, 107 250 there. See that? Right? And I'm going to put my mouse right here. Hang on. Let me highlight an area for you. 1 second. Okay, everybody pay close attention here. This is probably one of the most important things points we're gonna bring up today. Okay, everybody see that little blue area, right? Being on a trading floor, handling institutional order flow. What's happening in that little blue shaded area, there is lots of trading going on. Buying and selling, buying and selling, buying and selling. All the trades are taking around the same price, not exactly the same price, but right around the same price. Okay? In front of someone like me who's handling the order flow, you've got two stacks basically. You've got your buy orders and your sell orders. Okay? Right? Looking at the chart at that point before you see the drop in price, you don't know exactly what the outcome is going to be. But if you're on a trading floor, what do you think that looks like? And you're handling the order flow. Which stack is obviously bigger? The stack of sellers or the stack of buyers? Okay. Right? Exactly. And when exactly are prices going to fall as they did? They're going to fall when that last buy order is filled. Okay? And then you have no more buyers at that level, a significant amount of sellers, price has to drop. There can be no other outcome. All right? I know that sounds kind of simple and all that, but that's all it is. We don't need to take it any deeper than that. That's what's happening. That's what happened many years ago when I started. That's what's happening now, only the numbers are much bigger now. And it's much better. Okay? It's fantastic. People say you need to... there's a lot of complaints with people in any market are, hey, we can't see the order flow. People in the currency markets and Forex markets say we can't see order flow and we can't see volume. Well, guess what? You don't need to. All that information you're looking for in those two sources is found right on the price chart. If you bring everything back to the basics and ask yourself the most important questions, why can't price stay at a certain level? We see this level up here that prices fall from, where I have it highlighted. If you really truly understand why prices fell from there, Okay, then where to enter the trade becomes the low risk, high reward entry becomes very clear. Okay, there's two ways we can enter that trade, right? We can certainly short a breakdown. You can see the initial breakdown out of that level. Okay, but there's something we're going to focus on here. Let me just put another little, highlight another little area for you. Okay. All right, so everybody see that little blue circle over there down to the left there? Okay. If we are going to enter short on that initial drop from that level, okay, first of all, let me just back up a little bit. Sorry about that. There are two types of entries that you're ever going to take. One is going to be a breakout entry, either a breakout to the upside or a breakout to the downside. The other type of entry is going to be a reversal entry. Okay. No, I'm not using a pointer. I just highlighted those two areas. Okay. So don't worry about. Okay. So two types of entries: breakouts or reversals. The breakouts may pay you a little quicker, but they're not going to be as low risk and low stress as the reversal entries. Okay. All right. So let's say let's talk about the breakout first. If we sell short on a breakdown, an initial breakdown from that level, we are not going to sell short just because prices are falling from that level. The one thing that you have to do, okay, this is the difference between breakout trades that work and breakout trades that don't work. What are prices breaking out into? Okay, which means we have to look to the left, and you want to really be religious about that. Anytime you're considering a breakout entry, look to the left. All right. When we look to the left here, from that initial breakdown, when we look down and to the left, we see the first support or demand level is that blue circled area over there on the left. Why are we calling that support or demand? Simple, because when prices were there, they couldn't stay there. They rallied, right? That's just a pivot low. A lot of people will call that support, and it is. There's a reason why prices couldn't stay there. There's a reason why price spent such little time there. It's because of a big imbalance of buyers to sellers. A lot more buyers, very few sellers. Prices shoot up. Okay. So if we're going to take a breakdown entry up there at that bottom white line, that initial breakdown area, we just need to make sure that there's enough of a profit margin. Okay, and the profit margin is obviously the distance from our entry there to the support level. And if that's enough room for you, take the trade. Okay. The other type of entry, now again, breakout entries, they're fine. There's nothing wrong with taking them. They're excellent trades. It's a big popular entry at Online Trading Academy. But the other type of trade you can make is the first pullback up into that resistance area. Okay, and let's walk through this. So again, we have that area up there in between the two white lines. Prices initially fall from that level, right, from that blue circled area. They initially fall from there because supply greatly exceeds demand at that level. Okay. Eventually, they go down almost to 107 and then come all the way back up to the origin of that drop. Okay, now follow me here. Once they come back to the origin of that drop, why are we so excited about selling short up there? Simple, because we know that someone is buying after a move up in price and buying right into a price level where supply exceeds demand. Okay? If your strategy is to buy after a period of buying and buy into a price level where supply exceeds demand, what are the chances that you're going to be right? Your trades are going to work out. Right? What are the chances that you're going to make money in that trade? Buying after a period of buying and right into a price level where supply exceeds demand. And the area I'm talking about, let me show you here. Okay. 1 second here, I'll get it for you. Okay, so I'm talking about entering somewhere in, there's a very mechanical way that we do it. Okay. All right, so there's the that second blue area up there. That is the first time prices are revisiting a price level where we already know supply exceeds demand. How do we know that? Because of the initial drop in price. So when prices come back to that level for the first time or second time, we know that somebody is buying after a period of buying, mistake number one, and buying right into a price level where supply exceeds demand, mistake number two. The laws of supply and demand say that you're going to lose consistently if you take that action. Maybe not every time, but most of the time. Okay? Therefore, if we found the lowest probability trade, have we not also found the high probability trade? Okay? Everybody understand that? You want to sell to you want to trade with a consistent loser. That's the whole point. In short-term trading, it's crucial that you enter. We're really only going to be focusing on entries today. We don't have that much time, and the reason why we're going to be focusing on entries more than anything else is simply because that is the most important part of the trade. If you can get the entry right, the rest is not that difficult. But in short-term trading strategies, that entry is everything. Okay? All right. Let me just address some of these questions before we get too far ahead. Yeah, Frank, don't worry about it. You're a new guy. You have a big advantage here, right? You want to be new at this. It's much easier to train someone who's brand new at this stuff than someone who has a lot of experience. So don't think you're don't think you're behind. Okay. Okay. Pip Sniper there. Pip Sniper, could you say that about the initial move down, that sellers sold late into a move down? Well, remember, there's a lot of consistently profitable sellers in that area. Okay, they did not chase price down. Okay, maybe a very few of them did, but most did not. Most are selling up there and only up there, and that's why prices fall so quick. Okay. John has an excellent question here. How can you tell how many sellers are left at that level? Well, there's a number of ways you can do this. We talk about this a lot. These are the things that we're really going to be focusing on in detail at the conference. We've got that all laid out very mechanically and systematically, but I'll touch on some of it here. First of all, how did prices, how did prices leave that area? Did they leave in strong fashion, or did they just was it a gradual decline? Okay. Right, strong. So the fact that they left that area in strong fashion, does that suggest a big supply and demand imbalance up there, or a small supply and demand imbalance? Right. So we would assume there's a lot of sellers there because of the big initial drop. Okay. I think someone mentioned that lower line there being too high. No, I put it snug up against that price action there, and the reason why that line is right there, I could probably move the upper line up a little bit, but that lower line is really where you want it to be. Okay, and let me just fix that for you here. So I can show you. Okay, hang on 1 second. Okay, let me grab that for you again, and I'll explain why. Okay, so that little area there, the reason why the lower line is right there is because I want to focus in on the origin of that move. Where again, think of the order flow. Think of the paper orders we talked about earlier on a trading floor. Okay, again, that's where I started. That's where my mind always is, and what that looks like on a chart. Okay, the fact that prices dropped from right there, okay, that's where the meat of the supply is. It's right in that area. Okay, that's the origin of the drop. Okay. Don't worry about what we really want to do is take time out of the equation. Okay. Time again is something that really, at least I find, it's just my opinion, but I find time really messes people up. The more you can eliminate time from the equation, the more you can eliminate subjective information, the more you can eliminate lagging indicators and oscillators that only, pretty much add risk to your trading, right? Anything that lags price is going to add risk. The more you can eliminate those things, I find that the better people will do. Okay. When it retraces there, John, back up to the level, that's where you want to sell short. Okay. Okay. Yeah, when prices, good question there. When prices come back to these levels a number of times, again, that's something else. A lot of books, and I think you'll hear a lot of books kind of tell you that you want to see levels tested a few times, and if prices hold, then take the next retest. If you really think it through on your own, actually the opposite is true. Think about chopping a tree down, right? Every time you hit the tree, you're removing some mass. The tree is more likely to fall, right? It's the exact same thing here. Every time you come back to an area, you're removing some of the mass, some of the order flow, and again, price is more likely to, your supply or demand level is losing strength. Does that make sense? Okay, great. You can use indicators and oscillators. I don't, but you certainly can, and I think we talked about that a few sessions ago. There's a very good way to do it if you're going to use them, but you certainly don't need them. Okay. The most important thing, if you're going to use them, go ahead and use them if you want to, but make sure the foundation of your trading belief system, your trading strategy, make sure you've got the foundation right before you add anything to it. Understand how and why prices are moving from one area to the next. Okay? This is the things I'm talking about here are no different than things that Adam Smith said a few hundred years ago in his book, The Wealth of Nations, right? And this is no different than Isaac Newton and his motion into mass. Right? I'm not putting myself in the same league as those guys. I'm just saying they're all saying the same thing. You can't get away from that one governing dynamic. For some reason, when people come to charts and trading, it becomes some kind of art with fancy pictures and patterns and all that stuff. Okay? There's a reason why the vast majority of people lose when they trade. Okay. Okay. An oscillator, Jim, is just, you might want to Google that, just trading oscillator, just to get a bigger definition than I'll give you here. But it's an indicator that attempts to show you when a market is overbought or oversold. That's all. Okay, there's a number of them. Hey, but let me tell you something. If you never knew what an oscillator was, it's not going to hurt you at all. So don't worry about it. Why do prices retest? Boyke, that's an excellent question. Okay, why do prices retest? Let me ask you. Okay, here, follow me here. Okay, those levels where prices leave from, like that level we're looking at up there. Okay, who are the smart buyers and sellers? Who are the consistently who always makes money trading? For the most part, right? Banks. Okay. Not every bank, but the ones that, you know, if you're able to handle the order flow and trade for your own account, it's pretty tough not to make money. It's got to be something seriously wrong. But okay, so given the fact that you know, the big boys, the banks, whatever institutions are pretty much consistently profitable, right? Those are the levels that I'm showing you here. Okay. Why did prices? Let's focus on the chart again here. That little blue shaded area. Why did prices leave that level as they did? Too much supply there. Somebody had too much to sell. Who was it? Right? We're looking at Forex. It's a bank. That's a consistently profitable institution that has a lot to sell there. They have too much. There's not enough buyers there for them to get the whole order off. So prices drop and move away. Right? Understanding that, why do prices retest? Right? They have to. The banks, those institutions, prices have to come back to fill those orders. Again, I was a part of this game for years on the floor of an exchange. There are a lot of orders up there to sell. Prices need to come back to those orders, come back to retest those levels. If prices did not come back and retest those levels, you know, the institutions wouldn't be making the money that they do. Okay. John, to be honest with you, it's really the retail trader who is filling these institutional orders. Okay, and it's really just a transfer of accounts. Like any other business, it's a transfer of accounts from the retail trader who doesn't have the proper understanding into the accounts of the people that know. Right? It's a transfer of accounts. The people that don't know paying the people that know. Really, like any other business. Okay. All right. Does that help, Boyke? Understanding why prices revisit? When you could see where an institution or a bank's orders are, believe me, prices are coming back there. If they didn't, those groups would be out of business. Okay. So what a lot of people will do is you know, after a little while they say, yeah, wow, these levels are working. You know, they're helping me, but eventually that same person will always come back and say, you know what? All the levels that I have that I'm picking for reversals, prices almost always actually go to those levels. So how about trading in the direction of those areas? And that's something that we don't really talk about here too much, but that's something that's kind of another tool you can kind of add to your toolkit. Okay. Oh, you don't want to be on the floor. You could see it much better here. I'm telling you, at this point in my career, if you gave me the option, said, you know, you could be on a floor with the order flow right in front of you, or you can look at charts, I would choose the chart any day. I would argue that you could see what you want to see here better than you can see on the trading floor. The problem is, again, it comes back to what we were talking about before. How do most people get involved in this? Most people are not thinking along the lines that we're talking about. The average person that wants to get involved in trading their first move is usually going to be to go to a bookstore and buy a book written by someone who buys books. Writes books, right? For the most part. I'm not saying, you know, there's good information in every book, but there's no book out there that's that's going to give you the exact real deal. That book will never be written. Why would someone with the perfect trading strategy give it all away, right? Okay. The vast majority of books are going to be written by people who make money writing books and selling education. Okay, so you're not going to get, you know, and most of those books, as you know, I'm not telling you anything you don't know, most of those books are just loaded with conventional technical analysis. Okay? It's certainly helped me, but if I had someone explaining it, you know, if I had someone explaining that to me then, that this is what you need to look for on a price chart, you know, that would have been a different story. But absolutely, believe me, this is not because I have some special understanding of things, or I'm any smarter than anybody else. Believe me, that is not the case at all. I just happen to take a different path, not even by choice. Okay, so I just got a job on the floor with some of my hockey friends, not intending to do this for a career at all. But again, when you have orders sitting in front of you, and the order of the sell orders, the stack of sell orders is much bigger than the stack of buy orders. As soon as that last buy order is filled, prices have to drop. You see that happening in real time. You see it happening ahead of time. When prices rally all the way up to a level where you have all that supply, all that order flow, I would be sitting there and the phones would ring. And who do you think was buying when prices got to those levels where we had tons of orders to sell? Who do you think was buying up there? Retail or institution? Who do you think was buying up there? Yeah, the amateurs, right? The retail clients. Okay. The first retest on this level here that we're looking at, if you're on a trading floor, for example, those are mainly retail orders coming in on the buy side. Why are they coming in on the buy side? Well, what always accompanies a rally in price? You know, it's usually a bunch of green candles accompanied by very good news, right? With you know, everybody kind of jumping on the bandwagon, right? That's not how an institution thinks. Institutions or banks, they're not looking at any of that stuff. What's the point? They have the orders in front of them. Okay, sheep people, exactly. Exactly. John asked a question about the price system more on longer time frames. Absolutely. 4 hour, I think you're saying there, for sure. Monthly charts, weekly charts, daily charts, doesn't matter. Okay, and I'm not saying throw all the indicators and oscillators out the window. You know, use the indicators and oscillators to isolate the novice trader. We've done this before. I think there's a recorded version on the FX Street website. I'll have to check on that for you, but we did this before. You know, if you're going to use indicators and oscillators, one good idea is to use them to find the novice trader. Let me give you an example. Maybe use a 50 period or some moving average to tell you what the trend is, and maybe you're in an uptrend. Okay? And while you're in an uptrend, put an oscillator like CCI in that chart. Every time CCI goes oversold in the context of that uptrend, what's happening in reality? Someone is selling after a drop in price in the context of an uptrend. That's a novice trader. Okay, that's a very mechanical way of taking a very high probability trade. Okay. All right, you can use them to confirm things as well. Right. Ram is asking a question here. Okay. Short-term basis here, currency pairs will retest the equilibrium point. On a long-term basis, strength of the economy should reflect the strength of the currency. Well, first of all, it depends on what your of where you see equilibrium to be. Because I can tell you, if you ask any number of people, you're going to get almost that many answers of where equilibrium is. So, but yeah, prices in any market are going to spend most of their time at or near equilibrium. We want to identify where equilibrium is, then find the supply and demand points far away from equilibrium, as that is where the opportunity is. Okay. Long-term basis, strength of the economy should reflect the strength of currency. Absolutely, for sure. But again, you have to come back to the charts to time that entry. That's the key there. Okay. Does the institutional broker care about the pivot points? The pivot points are key. Okay, let's focus on one here. Let me just pull one up for you. Okay. This will just take a second here. Put a couple lines around this area. And 1 second, I'll grab this for you, and then we'll talk about it. Okay. All right. Let me grab the chart for you. Okay. So if you look at the pivot point on the left, okay, if you look on the pivot point on the left, where they have that little that blue little ellipse or whatever you call it, purple, prices stay there for a very short period of time and then shoot up. Okay, that is a much stronger support or demand level than that resistance level I was showing you before. The pivots are going to be much better than the bases. Okay, why? Because price only spends a short period of time there. Why does price spend such a short period of time? Because supply and demand are so out of balance. When prices revisit that level for the first time, okay, right there, the blue circle on the right there, you could see it. It comes in, touches that area, and shoots up. Okay, that's where we want to be entering on that first pullback. Okay, that pivot point on the left is certainly a support level, certainly a demand level, and a very strong one because prices spent so little time there and shot away from that area. Again, ask yourself the question, why can't prices stay at a level? If you understand that, you know, so many things are going to open up for you. Okay? Okay. Right, Mara is asking, why is there such exact symmetry in the charts sometimes? It's because this whole game, any market, it all comes down to order flow. And you have to be able to see and understand order flow on the price chart. Okay? Okay, just before I forgot, I just typed my email address in there, sseiden@tradingacademy.com. I know some of you I get emails from regularly. We chat, and that's great. You know, if you have any questions or comments or anything, or you want to just send a chart or something, usually I'm able to get back fairly quickly. It all depends on travel and stuff, but I'm happy to do it for you. So again, there's my email address if you need to email me with anything. But again, just to kind of reiterate how important it is to understand why prices leave certain levels, okay, and then take a look at where they go to. Okay, the first part is going to really take a look at the supply and demand equation at that area. Second part is going to help you with your profit margin. Okay. All right. That's a good question there, right, Charlotte. Who are the novice traders that can actually print the candle? That takes more money than retailers have? Not necessarily. Okay, not necessarily at all. You know, don't think because you see a candle that a lot of trades have taken place. Okay, especially when prices move quickly. Prices, for the most part, do not move quickly because you have a lot of buyers or a lot of sellers. They move quickly because there's an absence of one side. If you have two buyers and no sellers for a couple price points, you're going to see prices move faster than you can imagine. Okay? No, time frame does not matter at all. Don't worry about the time frame. In fact, it's always a good idea to look at multiple time frames. If you're a short-term trader, maybe your 2- and 5-minute charts, but also keeping an eye on that daily to see where you're at in the big picture. Okay, you definitely want to be looking at multiple time frames. The trend, absolutely. You absolutely want to talk about the trend. For today, we wanted to focus on just strictly price and price movement, understanding that. The next time, we're going to talk a lot more about trends, and we're going to combine the two. We're going to combine support and resistance with trends, and that is really all you need. Okay? I wouldn't worry about time of day too much. These markets are pretty much 24 hours now, so. Okay. It depends. It's kind of a little more than we have time for here. You're saying, you know, we talked about it quite a bit today. We've talked about it before, and we'll certainly talk about it again. You know, support and resistance and trends are the two most important things in trading. If you have those down, people that have those down real well, typically just stick to those two you know, types of analysis. Okay. All right. But I know we're kind of out of time here, and a lot of lot of speakers for you today, so I just want to say thank you for your time, and hopefully you got to most of your questions. And if you have any other questions or comments, just email me anytime. I'll type my email in there. I'll give it to you again. All right. Yeah, thanks a lot. Yeah, we'll see you here next time. Yeah, sorry about my voice. Little sniffles today. We'll see you here next time. Maybe we'll see you in Spain in a few months. And other than that, have a great day, everybody.